Hi, everybody. My name is Jason Heath, and I am being joined by Ryan Kurtz. We're going to be talking today about a beginner small business guide, a step-by-step guide on how to set up dividends versus salary. I find this is something that certainly people that are setting up new corporations are often not sure how they should go about doing this. Even people who've had corporations for a while sometimes aren't sure whether they should be paying dividends or salary. A lot of times people just stick with what they've been doing. And part of our session today is to just talk a little bit about the difference. So maybe you've got questions that you can ask your accountant. You can ask questions to Ryan. Ryan happens to be a certified financial planner as well as a chartered professional accountant. So he comes at things from two different perspectives, one being a financial planning perspective, one being a tax perspective. And when the two of them come together, it can make for really good integrated planning. So Ryan, thank you very much for joining us today.
Thanks for having me on, Jason.
So we got a bunch of questions we're going to plow through here, and hopefully we can hit on a bunch of different topics. First, salary versus dividends. Like most people have worked for an employer in the past and they've received salary and got payroll. But when you're an owner manager, you've got this option to take dividends. What's the difference between salary and dividends?
Yeah, so salary would be similar to what they received as an employee to another business. You're going to get a T4 at the end of the year. From the corporation's perspective, a salary is paid with pre-tax profits inside the business. So that's going to act as an expense inside the corporation and reduce your taxes inside the corporation. Dividends are paid with after-tax profits, not reducing a corporation's taxable income, not reducing their taxes. That's kind of the difference from the corporation standpoint between the two in terms of how they're treated inside the corporation.
Got it. So technically, if you're earning income inside your corporation, you turn around, you pay everything out to yourself as salary, the corporation would have no taxable income. It would be just as if you earned it personally in the first place.
Yeah, exactly.
Whereas dividend, you're paying a little bit of corporate tax first, and then you're paying a little bit of personal tax when you get the dividend.
Yeah.
Okay. I think that's an important distinction. A lot of times people, hear that tax is lower on dividends, so they want to pay themselves dividends, but that's only after you've paid some corporate tax first. And so what are the advantages and disadvantages of paying yourself a salary?
From the individual perspective, if you're paying yourself a salary, I guess one advantage is the tax is essentially prepaid. So come tax time, when you file your personal tax return, all of your remittances have been taken care of along the way. So you don't have to worry about, setting money aside to pay your tax bill at the end of the year. That's already been done for you. Another advantage is that you are going to generate RSP room by paying yourself a salary. And you're also going to contribute to CPP, which is a very powerful, indexed inflationary retirement tool that can be used later. So that's one of the, I guess, those are several advantages of paying yourself a salary. Some disadvantages is it's a little bit more, I'd say, rigid and not flexible. When you pay yourself a salary, you have to make sure that you remit that money by the 15th of the following month to the government, your CPP and your taxes. If not, you're going to owe interest and penalties. So you have to just make sure you're diligent about making those remittances. But honestly, that's, I'd say, a pretty minute disadvantage because there's so many great softwares out there that can do this automatically for you. You just kind of set it and forget it. So with advances in bookkeeping and technology, I'd say that disadvantage is not really one anymore.
I think the cash flow differences, receiving dividends and then having to account for taxes later, you can see people end up getting behind. So salary, even just from a budgetary perspective, salary can help sort of keep you on track. The money in your bank account's actually yours as opposed to some of it belonging to the government.
Yeah. That being said, from a cash flow perspective for a business, as like if you don't have steady cash flows in your business, maybe salary might not be the best for you just because there's not that flexibility. Kind of set it and forget it. But if you're not having steady cash flows, or a bulk of your revenue comes at the end of the year or the end of your fiscal year, you might not want your salaries coming out when you don't have that money. If you have the ability to, not pull out a salary and still live personally, then that might not be the best option for you. And that might be where dividends might be better suited to suit your business from a cash flow perspective.
And so do you see benefits to doing a little bit of both, where someone's got sort of a base level of salary where they think, I know I'm going to have enough corporate cash flow to pay out this level of salary, and I know I'm going to need at least this level for my living expenses, and then sort of sporadic dividends over the course of the year? Like, is there a place for a mix of the two?
Yeah, it doesn't have to be one or the other. I would say a combination is typically used across the board. And high level, I say pick a salary that'll cover your personal needs and also still not make your company, cash flow poor. So find that balance between corporate and personal that a salary can cover. And then if you do need additional money personally and there is cash in the company to flow out, then that's where the dividends can come in. And like you said, they can be sporadically throughout the year. But I'd say kind of salary baseline for your expenses personally, and then dividend on top of that.
And with a dividend, you can just pull money as needed effectively. I mean, it's your company, assuming it's your company, you can just take money at will, right?
Yeah, you can take the money out. That'll kind of just get tracked in what's called the shareholder loan balance. And then at the end of the year, whenever your fiscal year end is, and also come February, end of February is when dividends and T4s are due. So at that point, your accountant would declare a dividend and pick up all of those drawings that you've taken out over the year, and then get picked up on what's called a T5 slip. So T4 is salary and T5 is dividends.
You mentioned Canada Pension Plan and the benefits of CPP. I mean, especially for a business owner who doesn't have a defined benefit pension plan that somebody who works for a big company might have. What are the CPP differences of salary versus dividends?
Quite simply, by paying yourself a salary, you'll be required to pay CPP as well. If you are paying yourself dividends, you don't have to make CPP contributions. That's the biggest difference between the two.
And required. It's not a choice with salary. You pay salary, you pay into CPP.
Yeah.
If you're really anti-CPP, you could take dividends, but salary always has CPP contributions.
Yeah, as a business owner, CPP is required if you're paying yourself a salary. There is the option to opt out of EI. You don't have to pay yourself EI if you are paying yourself a salary as a business owner.
I guess it's hard to fire yourself or whatever, and there's probably some merit to not paying those EI premiums, not the same as when you work for somebody else.
Yeah.
And so payroll remittances, you mentioned, salary, you do your salary calculations. There's a certain amount of tax that needs to come off, and then monthly you remit payroll. Like, in practice, how does that work? Someone who is just setting up a new corporation, or somebody who's always taken dividends, if they want to pay salary and set themselves up on payroll, how does that actually look if you choose salary?
You kind of need to almost work backwards a little bit and say, how much do you need on a monthly basis after tax to live off of personally? And then from there, you're going to kind of work backwards, gross that up to include the CPP that you have to remit, as well as the tax. And then that's going to be the salary that is essentially deducted inside the corporation. And then, on a monthly basis, or however frequently you're paying yourself, you'll pay yourself that money. You'll get the net amount personally, and then the CPP and the payroll tax will need to be remitted to CRA by the 15th of the following month to avoid any interest or penalties on those remittances.
Got it. So it's a little bit more administrative work than dividends, but it sounds like it's the sort of thing that could be minutes a month, really.
A little bit more administrative. I usually send clients to either, a competent bookkeeper that can handle that. If they're confident themselves, just show them once and usually it's fine. Or if they don't even want to think about it, I send them to couple companies that I use are Payworks or WagePoint, and they're two companies that'll automatically take care of their remittances on a monthly basis, and will also take care of filing the T4s at the end of the year. So it makes it very seamless for business owners to pay themselves.
What sort of tax credits or benefits could you lose if you only paid dividends? There's some tax negatives from paying dividends.
If you pay yourself dividends, you're going to lose out on the employment credit. But if you pay yourself dividends, you also get the dividend tax credit. So there's credits available to both salary and dividends. With the Canadian tax system, the theory of integration, the thought is whether you pay yourself salary or dividends, at the end of the day, the tax should work out to be relatively the same. Obviously, there are specific cases where one might be better than the other, but on an overall basis, the idea is, regardless of salary or dividends, the total tax between corporate and personal should be about the same.
And there's that RSP angle that you mentioned, which obviously is a big opportunity, especially for somebody who likes contributing to their RSPs. So it sounds like it's a case by case basis.
Yeah.
You mentioned tax slips at the end of the year. Can you elaborate a little bit on those, how T slips and those filings work annually?
Yeah. So at the end of February of the following year, you'd be required to file either a T4 for your salary or a T5 for your dividend. And those would just get picked up on your personal tax return and reported to CRA, so they know, on paper what you've pulled out of the company, both as a salary and as a dividend, and then you're required to report those on your corresponding tax return for that year.
And what do most people do? Do they do it themselves, bookkeeper, accountant? I mean, whose job is it to do those?
It varies, depends on the individual. Some people are fine to do it themselves. Some people have their bookkeeper take care of it. Some people have their accountant take care of it. If you're using one of those softwares that I've mentioned, they'll take care of the T4 itself. The T5 you'd probably have to have done by your accountant.
I just want to go back a little bit just to sort of walk through. You mentioned in one of the first questions on how paying salary versus paying dividends impacts your corporation's taxable income. So your corporation has to file a corporate tax return. It earns income that it needs to report, pays expenses that it deducts. How does the salary and dividends play into the corporate taxable income? Just to elaborate a bit.
So you'd have your revenues inside your corporation minus off the expenses. So labor, materials, all the things that go into, driving that revenue. And one of those things that is a allowable deduction is salaries, whether to employees or the owners of the business. That would be an expense that's going to reduce your taxable income inside the corporation. And then essentially the corporation will pay less tax because there's less taxable income. The flip side of that is dividends, where you're going to have that same revenue, but you're not going to have those same amount of expenses because you haven't paid yourself a salary or a wage. You'll have a higher taxable income inside the corporation. And then after that tax has been paid, you'd have retained earnings, and that's what the dividends come out from, is paid with after-tax dollars.
And just to reconfirm then, so those after-tax dollars, you pay, 10 or 12% corporate tax. I suppose it depends on the province, depends on, the exact business. And then you pay a slightly lower rate of personal tax on the dividends because of the integration that happens.
Yeah, you'll get a dividend tax credit to help kind of reduce the amount of tax that's paid on that income that comes out.
But the key is not a huge difference between paying salary and dividends. It's not like you're going to end up saving like thousands and thousands of dollars paying salary versus dividends. It just doesn't work that way, or generally doesn't work that way.
Generally doesn't work that way. There can be some nuances in, specific cases where it might be, but on an overall, broad basis, yeah, that's the theory.
How do you go about as an accountant determining the mix of salary and dividends? Is there like a rule of thumb that you like to use depending on the type of business or the age of the person, or what are the factors that you consider?
I think that's where that planning piece comes in for me, and having that designation. It's more having that conversation with the client, and figuring out, how much do they need right now to live? How much do they need on top of that to maybe save for retirement, whether that's funding TFSAs, RSPs. So really, I think it comes down to having the conversation with the client and figuring out what their cash needs are now, what their goals are in the future, and then we can kind of come up with that ideal mix of salary and maybe dividends to make sure that happens and grows over time to fulfill those goals.
I guess even that CPP angle, I find that's always a controversial one. Some people are, really anti CPP and don't want to pay into it. And there's ways to not pay into it by taking dividends, pros and cons to doing that for sure. But it sounds like it's definitely a personalized thing. And on paying dividends, so are there any special rules? Like, do you need to have a certain level of profit or regular cash flow to support dividend payments? Are there situations where you can't pay dividends?
No, there's no set rule. You can pay dividends really anytime. They're quite flexible in that sense.
And it's just a matter of the individual who's receiving the dividends being a shareholder of the company, which a company always needs to have a shareholder.
Yeah, exactly. That's the main stipulation. Are you a shareholder of the company to receive a dividend? And I guess, are you actively involved in the business? If you're a spouse or significant other of the shareholder of a business, and even if you are the shareholder but you're not actively involved, you can't receive dividends unless you're actively working in the business, thanks to the tax on split income rule.
Which causes the dividends to be taxed at the highest tax rate, I guess. Yeah. So used to be different pre 2018.
Yes.
Much more restrictive now.
Yeah.
So our RSP contributions, you mentioned those, and just want to delve in a little bit more. So dividends do not create RSP room. Salary does. How does salary create RSP room? How does that work?
So RSP is earned by 18% or up to 18% of your earned income to a cap. The annual cap is indexed for inflation on an annual basis. So wages count as earned income, dividends don't. But because dividends aren't earned income, they don't generate that RSP contribution room. Whereas with the salary, you're going to have that RSP room grow over time because of that earned income, which is a great tool. You don't have to max out your RSPs on an annual basis. You don't have to pull out all the cash from the corporation to fund those. I kind of view that RSP as another lever to pull and can sometimes provide great planning in the future, even if it's not maxed out year over year. Maybe at some point you pull a large dividend out or a capital dividend, which is tax free. Well, now you have kind of created room for that money to go into a tax deferred portfolio.
Yeah, I think there's something to be said about having diversification from your income sources, and having some RSPs and corporate assets and TFSAs as opposed to all in on one or the other. So I think a lot of that boils down to the financial planning, retirement planning component, which goes beyond a lot of conversations people have with their accountant. So I'm curious if you've got experience with this. When it comes to applying for a mortgage, I feel like it's always more complicated for a business owner. Is there an impact on borrowing and mortgage qualification if you're receiving salary or dividends? Is one better or worse? Any considerations there?
I would defer to your mortgage specialist. Every bank kind of has different nuances. I know in the past, I'm not sure if it's changed, but salaries typically are more favorable just because it shows, as more steady income, earned income. So banks kind of like to use that salary as opposed to dividends. But I guess if you can show them a clear history of you taking X amount in dividends out, they might be okay with it. But it is something, if you're thinking of borrowing money, personally, talk to your lending specialist to see what they need.
No, that's helpful. I think the earlier the better, and give yourself lots of time as a business owner, because it can take longer. So, and so then what happens if your business has a loss in a given year? I mean, can you still pay dividends? Can you pay a salary if your business loses money?
It depends whether that's a cash loss or just on like a net income loss. If your company still has the cash to pay you a salary or a dividend and you still need that money to live off personally, then yes. But if the business doesn't have the cash to pay a dividend or a salary, then I guess the answer is no, unless you're borrowing and increasing debt in the corporation, then there is that way. But if there's no cash to pay a dividend or a salary, I'd, maybe advise against it.
It's almost like boils back to that mortgage qualification question. Somebody might want to make it look like they have a certain personal income, but if the company is losing money, you can't declare a dividend or pay a salary when there's no, cash to pay it. So, and like from a practical perspective, then, if you want to register for payroll, say you've again just set up your corporation, or you've only been paying dividends, you don't have any employees. How do you get set up for payroll to start paying yourself a salary?
You'd have your CRA business number registered with your business once you incorporate, and then you'd simply have to set up a payroll number, which would be the same business number, but it's just instead of RC at the end, it's going to be RP at the end, and that's going to be your payroll number. You'll get that set up, and then kind of what we talked about earlier, you'd figure out who's processing your payroll, whether that's you, whether that's a bookkeeper, whether that's your accountant, whether it's a payroll software company, figure that out. And then you kind of just input the amount of salary you want and figure out the remittances you have to make and go from there.
Salary, you've mentioned monthly and monthly remittances. I mean, you can pay yourself on whatever schedule you want, right? It doesn't have to be monthly. It could be weekly, it could be daily. I mean, you probably wouldn't do that, but there's no rules.
No real rules. It's just figure out what works best for you personally and cash flow needs, whether that's, once a month, bi-weekly, weekly, figure out the frequency that works best for you and your business as well from a cash flow perspective.
And so what about dividends? I mean, normally a publicly traded stock pays dividends on a quarterly basis. Does it need to be the same, or is there more flexibility?
There's a lot of flexibility. Really take the money out when you need it personally, and when the company has the cash to do so, you can take that money out. The only thing that I, provide advice on there to clients is sometimes I find people can get in a spiral with the dividends. They take that money out, then comes tax time. They haven't been diligent about putting away a percentage for taxes. And now that tax bill comes and they don't have the personal money to pay that dividend or that tax bill. So what do? They take more money out of the corporation to pay that tax bill. And they're kind of in a downward spiral, of paying this tax because of these dividends. So dividends are easy, but you just need to make sure you're diligent about putting that money away for personal tax filings.
No, I think it's definitely a risk. I mean, there's a lot of considerations people need to take into account as it relates to sort of beginner small business steps, or even established small business steps. So it's been helpful, Ryan, to walk through a guide on setting up dividends versus salaries, some of the pros, some of the cons. Appreciate the opportunity to speak with you today.
Yeah, my pleasure. Thanks for having me on.
And so thanks very much to the Summit audience for tuning in. Step-by-step guide, how to set up dividends versus salary. You've been listening to Ryan Kurtz. He's a certified financial planner and a chartered professional accountant at Objective Financial Partners. Thanks so much for tuning in.